Hi, everyone. Welcome to episode 2 of 5 of our series on trading bull put spreads, a popular option strategy for generating income in a bullish market. If you've ever wondered how traders combine two options to manage risk while earning a premium, you're in the right place. I want to be sure you are ready for this content and not jumping in over your head. So, if you have not yet watched episode 1, heeded all my warnings, and taken my readiness quiz, I hope you'll check it out and make sure that you're in the right place here. I'm Patricia Saylor, managing partner of Saylor Financial Fundamentals. I teach novice investors and novice options traders to be successful. I really want you to be successful too. If you've watched any of my other content, you know that I focus on making sure my students and viewers understand the underlying concepts guiding their trades and investments, including the rights and commitments of the options contracts that they enter. In this episode, we'll cover the two components or legs of the bull put spread. Trade outcomes and trade management will be covered a little later in the series. Let's start by breaking down this strategy step by step, starting with why traders use it, and then exploring its two key components. Bull put spreads allow you to collect income upfront while capping your potential losses, making it a defined risk strategy. Defined risk means you know at the outset what your maximum loss could be, and you can control your risk with the strike prices you select. This setup actually involves two trades called the trade legs, which you open at the same time with the same expiration date. You sell one of them for income and pay for the other one to reduce your risk. Since you receive more income for the first trade than you pay for the second one, you receive a net cash credit in your account at the outset when you set up this trade. I know this sounds complicated, but I'm going to really break it down for you. First, a quick reminder about terminology. When you sell an option, you receive money up front. It's called a short position. It shows up in your account as a negative dollar amount until the contract expires or is assigned. The negative number represents the amount you would need to pay if you decided to close the contract and end your obligation. When you buy an option, you pay money up front for it. It's called a long position. It shows up in your account as a positive number until it is assigned, is exercised, or the contract expires. The positive number represents the amount you could receive if you decided to sell back the contract to close the position early. Today, we break down the bull put spread into its two essential components: the short leg, where you sell a put to generate income, and the long leg, where you buy a put to limit your risk. We also explore how these two legs work together to create a defined risk trade. We'll use as our example the well-known and highly traded ETF QQQ, which is currently trading at $529.73 a share. Let's start with the short leg. The first leg of a bull put spread involves selling a put option. As you know from selling cash secured puts, when you sell a put, you get paid up front. By entering the contract, you commit to buy 100 shares of the underlying stock at the strike price. If the price of the stock drops, you may be asked to fulfill that obligation and buy the shares, paying for them at the strike price at any time until the expiration date of the contract. Note that in contrast to a bull put spread, when you sell a cash secured put, you may even be hoping you'll be assigned to buy the shares, especially if you're using the put to buy the stock at a discount. But if you set up a bull put spread, your goals for the trade are different. You are trying to generate cash, but you usually do not want to buy 100 shares, and you may not even have enough cash in your account to pay for that many shares. That's what makes this trade riskier than a cash secured put. In my QQQ example, I sell a put with a strike price of $521, and I receive a premium payment of $34. When I accept that $34, I have entered a contract. My contractual obligation means that until the put expires, I'm on the hook to buy 100 shares of QQQ and pay $52,100 for them at any time. So if the share price drops below $521, someone is probably going to force me to buy those shares. Remember this part of the setup because we're going to return to it. The second leg involves buying a put option that expires on the same day, but with a lower strike price than the first leg. When you buy a put, the contract gives you the right to sell the stock at the strike price anytime until the contract expires. This second leg acts as insurance, limiting your risk if the stock price drops significantly. You pay a premium for this protection. The second leg of my trade on QQQ is a $519 put. This time, instead of selling the put, I buy it, and I pay $23 for it. Now I have just bought the right to require someone else to pay me $51,900 for 100 shares of QQQ. So let's look at the two legs side by side and then see what they mean for my QQQ trade. With a bull put spread, I sell a put with a higher strike price and buy a put with a lower strike. If the share price stays above my higher strike price, everything will expire and I don't buy or sell any shares. But if the two contracts go in the money, I may be assigned to buy 100 shares at the higher strike price, but I can turn around and sell them at the lower strike price. The difference between the two strike prices determines my maximum loss at expiration. For my QQQ trade, at opening, for leg number 1, I sold a put and received $34. For leg number 2, I bought a put and paid $23. This gave me a total net credit of $11. After $1.32 in trading fees, $9.68 was added to my account. As long as the share price stays above 521 for the next 2 days, I'm in great shape. Everything will expire and I made $9.68 for my trouble. In the worst case scenario, the share price drops significantly. Leg number 1 requires me to buy 100 shares at $521 a share, while leg number 2 allows me to turn around and sell them for $519 a share. This would result in a $2 per share loss. If this happens, I'd buy the shares for $52,100 and sell them for $51,900, leading to a $200 loss at expiration. Now that you know how to set up the trade and what the contracts you are entering actually mean, you're ready to dive deeper into the setup and possible outcome of a bull put spread. In episode 3, we will look at exactly how to set up the order and enter the numbers on a trade log. And in episode 4, we'll analyze more deeply the different possible outcomes of a bull put spread based on how the underlying stock performs. And if you need to take a step back, or if you prefer a different learning format, check out these other resources. The Novice Investor's Guide to Stocks, Funds, and Options has 6 chapters for novice investors to not-so-novice options traders. Check out the table of contents to see if it might be right for you. My online trading videos for QQQ and SCHD cover cash-secured puts and covered calls. My Udemy courses offer a quick and organized way to cover investing and options content. And if you ever want to meet me for a one-on-one session to discuss your own questions, you can sign up on Fiverr. Before you move on to episode 3, let's make sure you know the terminology and that you understand what we've covered so far. Make sure you know the meaning of all these terms: bull put spread, short leg, long leg, defined risk strategy, and premium. And now for a few review questions. What are the 2 key components of a bull put spread and how do they work together? How does a bull put spread differ from selling a cash secured put? What is the maximum potential loss in a bull put spread and how is it calculated? Why is the long leg of a bull put spread considered insurance? What does defined risk strategy mean in the context of a bull put spread? And finally, don't forget to do some homework. I'd like you to set up a hypothetical trade. Choose a stock or ETF that you're familiar with. Identify a strike price for the short leg and a lower strike price for the long leg. Determine the premiums for both legs using an options chain. Calculate the net premium received and your maximum potential loss. In your own words, describe the obligations of the short leg and the protections offered by the long leg in your hypothetical trade. Include what the worst case scenario for this trade would look like and how the long leg protects you. Don't forget to download the definitions and answer key from my website and put your homework results in the video comments. And I'll see you in the next episode.